From the fast action of the trading pit to the power brokers making the headlines, you'll hear it all on the Traders Network Show with your host, Michael Yorba. Michael interviews the front page titans about the latest in trading tools and market trends in stocks, commodities, bonds, forex, and derivatives. The Traders Network helps you stay ahead of the curve and delivers tomorrow's trade today. Now, here's your host, Michael Yorba.
Michael Yorba, your host. Thanks for joining us. We're also streaming to you live from Deep Ellum on Air. Okay. All right, it's Monday. We've got David Williams with us right now. We've got quite a little rally we had going on in the stock market. I'm sure there's more to talk to this about on this story than that. David, welcome back to the show. Thanks for being here. Oh, I think we got a little technical glitch here. We're going to work that out and see if we can get Dave's audio up and running so we can bring him in on the show here. 1 second. David, how are you?
I'm good, Michael. How are you?
Good. Thanks for being here. I really appreciate this.
My pleasure. My pleasure.
All right. I see you got the S&P up on your GoToWebinar chart, your trading platform. Mm-hmm. Is that where you wanted to start today?
Sure. Today has been a nice day in the S&P. We're happy to see that it's up. And as you recall, last week we talked about July 9th being the next important bottom, plus or minus a day.
Right.
The market did bottom on the 10th, which was 1 day late. And we wanted to see the $1,948 to $1,947 reached. They did. And because they reached it, that sort of gave us additional insight that the market would do its normal thing off of this bottom, which is to advance and to produce a multi-day rally. And so that's what we've seen, and we're happy to see that. And we have subscribers that are taking advantage of that move.
You usually put positions on in three forms. You take profits 3 different times. I've seen you do that.
Yes.
What's your thoughts on the markets with that question in mind?
Well, it's a good question. We like the idea that the market wants to test 1975 on the upside, if not higher. And if we close below after testing 75, today's high happens to be 74 so far, but if we close below 75 after testing it, that is a weaker position for the market. If we close above 75 after testing it, that would keep people in their position for the possibility of higher prices.
Okay, got it. 1975 is the line in the sand for today. Got that.
Yeah, it's pretty important. And, we understand that that's very close to the all-time highs in the market, but that is the number. That's one of the important numbers. And over the weekend, on Sunday, in this middle chart here, we gave out just an indication that the market would likely be going up to 1968 to 1969 in today's early session. This is when the market was back down at around 64 to 65. Mm-hmm. Just a small move, just a 4-point move, but they did do it on the overnight, and they completed it, which is further evidence that the market is acting very normally up here in spite of being at very, very high, very elevated price levels.
Now, when we spoke last week, you were thinking that this was going to be a rally that would lead us to an exhaustion phase, if I remember correctly, and we may roll over after this, not just pull back and make another high. Are you still thinking that?
Yeah, we don't have a forecast directly right now for whether or not we make a new high, although I think it's likely that we will, but we don't have an outright forecast yet for that. And, many people who utilize, we're in a phase in this market where what you normally utilize is probably not working. People who have overbought and oversold types of indications and indicators. In a runaway bull market, you're in a different phase entirely. And because of that, things that work under normal conditions don't work under these conditions, or they certainly don't work as well. And so we've been telling people to be comfortable in buying the market because many people are not, and that's based on fear that the market's ready to crash, and it isn't. We are very confident that we still have time left before this whole move on the upside is over yet, and we like the idea of buying reflected wave pullbacks just like you've seen us do here.
Okay, all right. Point well taken. So, but at this point, you're not flat in the S&P market. You still have some of your subscribers long.
Some of our subscribers are in this. This wasn't an official outright trade. We just informed them that the bottom is in. We wanted to see 48 get reached, 1948, and that the thing was buyable. And then we gave the indication last night that they would be up higher today. And so this was really probably more self-directed for these traders, but they get our information in this particular case about what we thought would happen in the market. It has happened. We talked about it last week on your program. We're very happy to see the continuation move today on the upside.
Okay. All right. The other chart that you have up there is the crude oil market.
Yes, it's crude oil. We're continuing to watch crude, which really has been remarkable in that it has declined during a very complex and very volatile situation that's only getting worse in Iraq, Syria, with Israel. I mean, the whole playground out there is just one powder keg after another, and yet crude oil has declined quite nicely. We did put out a forecast today for crude oil, and it's possible we may take advantage of that forecast. If your listeners want to take a look at that forecast, they can. It's relatively short term. It has to do with just this week alone, but they can take a trial of Williams Edge and get the full information that we put out regarding crude.
Are you going to have a webinar tomorrow, Tuesday?
We are. Thank you for asking, Michael. We are going to have a webinar tomorrow. We do have them usually on Tuesdays and Thursdays. Tomorrow is Tuesday, July 15th, and we will have one at 1:30 Pacific time tomorrow. And your listeners can come to pagetrader.com and check out what we're doing. And just click on the link, click on the date for July 15th, and it'll put you into the trial. And during these, not the trial, but the webinar, during these webinars, I like to answer questions. We go over what it is that we're doing. What we are doing is we're looking at the markets with the view to taking the highest probability trade setup that we can find and trade that utilizing risk management. And although that may sound like a normal thing to do, I think if you watch what we're doing, you'll find out that where we excel is in finding the high probabilities. And that's the difference. Anybody can use the phrase, but to actually find the high probability setups where the probabilities have a number of different things that are going to happen is somewhat unique. And that's what we want to show them in our webinar tomorrow. So we invite all of your listeners to come and spend a little time with us. We'll go over it and I'll explain very clearly what we're doing and how we do this.
Okay. Let me get back to the crude oil for just a second here. You
Sure.
had mentioned previous that we're coming up into, and I think it was June, that you were talking about some kind of a turn for biblical proportions in the move of crude oil. You still think we've got a big upside there?
Well, our original forecast was, this was made in March of this year, that crude oil would make a bottom on the continuation chart of crude oil in the month of May, and it would start a near biblical, likely an advance from that point. And it did bottom in May. We made about a 10-point advance, which is not biblical, of course. But the important thing is that this decline does not fit in with that move at this point. And so because we're flat in the market right now, because we are watching and waiting, we don't have a new forecast just yet. That new forecast may actually coincide with our original forecast, but we have to see a little bit more because we were taken by surprise with this decline being the size that it is. And so we're on the sidelines, so to speak, waiting for another very high probability indication for us. And there's no shame in stepping aside and saying, you know what, we don't understand this particular section of the market. We don't understand most sections of the markets, but the part that we do understand, we're pretty good. And when we get those parts, that's the part that we're investing in and trading. And that's what we really want to show off in our webinar to your listeners.
I want to bring out something else that you do, and that is you trade equities. You've been trading equities for a number of years. Could you talk to our audience about what that program consists of?
Sure. We do have Williams Edge for stocks, and we ourselves trade very heavily in options on stocks, and we also own outright many different stocks. And we've been doing this for many, many years. We have a statement that we show that has been reviewed by Bert Schlichter from Daniels Trading, where we show about 3.5 years of our ongoing statement where we're selling call and put premium in these markets, in the various stock market, and what we've been able to do with that. And so we'll show that in our next Reflected Wave webinar, which may be coming up this week. I don't have my schedule right in front of me, but I can tell you that we've done well, and we'd like to show people what we think is possible by utilizing option premium, selling option premium against these Reflected Wave tops and bottoms that we are utilizing in these markets. You have to see it. The words, it's kind of wordy, but I'd like to show it to you in person, and that's what the purpose of those webinars are.
Right. Is there any room left in the seminar that you're going to have? I think it's September.
We do. We have a few seats remaining for the September 20th and 21st Reflected Wave seminar. That's where we teach I'm actually the one that teaches the Reflected Wave seminar. I know the subject thoroughly. I know what people are looking to do with this because we've shown them what to expect, and I'm going to show them how to do all of that and more, even some things that we don't even talk about until the seminar. I'm very excited about these seminars. We put a lot of time and effort into them, and we want to raise the level of people's ability to know when a future top or bottom is going to occur, and to be able to do many of the clever things that we sometimes do with these markets that we've shown on your program so many times, Michael.
Yeah, I wanted to make sure everybody got that information because it's always sold out. You sell out every year. Let me move forward, if I may, on a couple of the other markets. You do very well at trading the euro, the U.S. dollar, the bond market. Is there anything that looks like it might be coming up on your radar in regards to these other markets that you've traded here on the show?
The dollar, we may be taking another position soon in the dollar. Right now, we're flat in everything. It just so happens that most of the moves that we might forecast are sort of transitional, meaning that the S&P is in the process of completing and rallying off of the bottom we forecast for July 9th. The gold market sold off today off of the Reflected Wave top that they put in. So a lot of things are sort of in transition on the way to our next setup. So we're flat now, and probably we'll see a pickup. But you have to remember we're also in the middle of the summer, or we're inching in on the middle of the summer. And that often is a quiet down period where maybe the markets slow down a little bit. And if they do, so do we. We slow down a little bit and we just wait.
We had a pretty good move in the gold market today, about a $30 drop.
We did.
Any thoughts on that?
Well, we had put out just last night in our Williams Edge that the gold market had put in a Reflected Wave top, and we expected a multi-day decline, and therefore we moved our stop up on our remaining long position that we had. We were stopped out of that, and we had a successful trade on the long side. So the only thing I would say that is surprising about the gold market is that it did it all in one day, rather than simply doing it in 2 or 3 days. It did it all in one day, which is fine, and we're very interested, and we think that another very important bottom is likely into Tuesday, which is tomorrow, July 15th.
I'm glad I was able to bring that up. All right, David, that's all we've got for today. I want to thank you. You'll be back here again on Wednesday, right?
Yeah, Michael, it's a pleasure to be on. Happy to be on your new television program, and we'll be back with you on Wednesday to go over the markets and hopefully have a little bit more to put out there for you, your listeners.
All right, David, thanks so much. We'll talk to you Wednesday.
Thank you, Michael, for having me on. I appreciate it.
You're welcome. All right, that was David Williams, president, PageTrader.com. Please, if you haven't done it yet, go into the webinars with him, see these amazing techniques that this man has been bringing and broadcasting, whether it's on our radio show or our television show. We're going to come back on the other side of these breaks with Garrett Jones, Money Manager, Stock Market Cycles. He's going to give us his take on the market. We'll be right back.
It's not your daddy's farm anymore. There's no doubt technology has changed the way we grow bigger crops, feed our livestock, and also access market information. With the new Yorba Market Center, today's farmers and ranchers are embracing new technology through smartphones, tablets, and the internet to give their business an edge. The Yorba Market Center gives you real-time quote access, news, and weather at a low monthly rate to help you stay better informed. Visit us today for a free trial at yorbamedia.com or call 214-504-9470.
Go to pagetrader.com right now and sign up for a free trial of Messenger Pro. Messenger Pro will give you the latest multi-day and multi-week price roadmaps for exactly where the S&P 500, gold, crude, the euro, and many other markets are going. Put the power of the roadmap to work in your next trade. That's pagetrader.com or call toll-free at 888-231-4702. pagetrader.com.
Tired of being on the wrong side of the trade? Frustrated with the Wall Street fat cats making billions? Smart money is now flocking to those who have a proven edge. InTheMoneyStocks.com has a proven track record of profitability, and they're willing to reveal their winning strategies. For over a decade, peers have reviewed the proprietary strategies created by the pro traders and investors at InTheMoneyStocks.com. It has been confirmed as the best trading and investing strategy in the world. Now is your chance to learn the expert methodology in this exclusive methodology revealed webinar. You are well aware of the stock market collapse which occurred in 2007. The In the Money Stocks methodology located and alerted members of the impending collapse before it happened. Not only did members protect themselves during the collapse, they profited as well. Reserve your space for the next InTheMoneyStocks.com methodology revealed webinar by signing up under the education section at InTheMoneyStocks.com or email at support@InTheMoneyStocks.com. Your chance to obtain this powerful knowledge is now. Live the dream and profit for life.
Welcome back to the Traders Network. I'm Michael Yorba, your host. Thanks for tuning in with us. We're broadcasting to you live from Deep Ellum on air. I've got Garrett Jones, money manager at Stock Market Cycles, with us on the show today. He's got his charts posted on our social network. We're going to bring those up on the show and push them out onto our player. All right, Garrett, welcome back to the show. How are you doing?
I'm good, Michael. Thank you. How are you?
All right, my pleasure. All right, Garrett, I wanted to get your take on what's going on with the stock market right now. What do you think is going to happen next?
Well, we've been in kind of a relentless uptrend, which is what I was showing on the first chart.
Garrett, your audio's coming through just a little low. If you could either turn your microphone, talk into it, or if you're on a speaker or a Bluetooth, take it off so we can hear you better. I want the audience to get to hear you. Is that better, Garrett? Hello?
Can you hear me?
Yeah.
Is this better or better the way it was before?
It's about the same. All right. Well, do us a favor. Just speak up a little bit to us, for us. I've got your charts up on the show.
All right. Can you hear me okay now?
Please, go right ahead.
What I've got is a S&P Cash Index monthly chart. So, I mean, it goes back to 1995, and you can see that big run up in 1995 into 2000 and the moves. The current, what I did here, Michael, is I highlighted the initial move coming out of 2009 in a blue channel, and it shows a pretty sharp uptrend angle. I mean, a pretty strong rally. Okay. And then you had that large correction into 2011, and since then we've been in a tighter channel with a greater upward thrust. So it's been really nothing but bull market with not much correction along the way. I mean, we've had a few corrections, but nothing incredible and nothing that's broken you out of that channel. So the message is the trend is your friend, and until that channel is broken, you've got a pretty much uninterrupted bull market. I think we're getting late in that cycle, but I put those two internal lines, the red and the yellow lines, in there, and as long as both of those are pointing up, we're headed higher. So, and I do have some short-term stuff a little later. I brought an institutional index chart as well, Michael, and I brought that along because the market's pretty much controlled by the institutions, and this shows again the same situation. What I think is important on the institutional chart is I connected the trend line of the lows from 2002 to 2009 and extended it off the top in 2000. One thing to notice about this top is that you didn't have a higher high at the 2007 high as you did in some of the major indexes. You had, in fact, a perfect 618 retracement, which made it look very bearish at the time. But you've come back and broken that high, and now you've broken out of the channel line a while back. So this implies that the market's going to go higher. And I put on there the next logical turning point for the institutional index would be that 88.2% Fibonacci retracement off the 2000 all-time high and the 2009 low. So again, it's all things go, but my guess is I'd be very concerned because we're actually overdue for some type of a decent correction. And what I wanted to show you along those lines are some of the psychological influences, because I think if you're a short-term trader and you're trading the hot stocks, you're probably having a great time. It's that type of market. However, if you want to look at the big picture, the message is, hey, it's a bull market until it stops being a bull market. But we're awfully extended, and the risk level here is pretty high. And a couple of things that show that risk, if my third chart here is consumer confidence and the velocity of money. And what you see on there is the consumer confidence line going into a rising wedge pattern that peaked in 2000 at the market top, and then it collapsed. You had the same thing happen in 2007 going over into 2008, and it collapsed. And now you've got exactly the same pattern actually coming into a trend line with these other two magnificent tops.
It looks like it's about to break out.
Yeah, it does. But I mean, I think the key there, it'll be interesting because if that's the case, I mean, you're just going to get a high level, ultra high level of confidence, and you've got the problem is the velocity of money and the combination of these two things. So
we're having the velocity of money continue to drop as consumer confidence is continuing to peak relative to where it's a lower peak. But so that combination of something what does that tell you? Obviously, late in the tooth or long in the tooth on the rally, but does it give you any timing mechanisms when this happens? In other words, sometimes things get stretched so far that they can only go so far, and then they've got to make some adjustments.
I think you hit the nail on the head. That's kind of what happens. I mean, if velocity of money were different, and if people were really moving money around, and if banks were making loans, and if things like that were happening, it would tend to elongate this process. I've always been concerned with the degree of debt that has to be dealt with, and they're doing a great job of trying to eliminate a lot of that debt in the market, and they've talked about ending QE. But when you have that degree of debt, at least historically, that's always been the major concern. And one of the functions of the long wave cycle is that you have a winter in that cycle, and that's where debt is either forgiven or defaulted on or something. Bottom line is it goes away, and the good news of that is it's going to be difficult going through that, but it clears the slate and it opens the door for a robust news cycle. If you don't do that and you don't eliminate the debt, then you don't clear the slate, and you continue having a labored market that history would say sooner or later is going to cause something very bad to happen. So the question here is, do we go with the new thing, assuming that the Fed's going to solve all our problems? Because remember, the Fed's been around for a while. They were going to solve all our problems leading into 1929. We had a depression where the market went down 90%. They were still around in 2008. They didn't seem to solve those problems. All that I've seen here is a shift of assets over to the Federal Reserve that used to be real estate owned by Americans. So, if that's a good thing, so be it. We'll have to wait and see. But one of the other things on here, Michael, is that fourth chart that I had.
Gary, I have a real quick question for you before we move on to the fourth chart, and I'll make it quick.
Sure.
Relative to where we are now with this velocity of money, how are we in regards to where we were in 2000 and some of these, 87, some of these other major pullbacks? Is it at a critical level, or do you see that there's a lot more room on the downside for velocity of money to fall relative to where it is now?
Well, I mean, I think what's happened so far has surprised most people who've been aware of that. So the question is, I don't think that's a question that anybody can answer.
Okay.
I think you've just got to take a look at history and take a look at, in my case, some trend lines and things of that nature. And I've had trend lines being broken to the upside. Everybody has, and that's part of the thing. And I think when people start to get to the point where we go, well, gee, gosh, every trend line is going to be broken to the upside. About that time, you're going to have one of these trend lines hold like a rock, and you'll get a different outcome. But I think the message is, for those people who are short-term traders, go ahead and do what you've been doing. For those who are a little concerned about the bigger picture, maybe it's a good idea to take some steps in that direction too. And right now, what I was going to show in that next chart, Michael, is that we've got of the IPOs coming out, 83% of them have negative earnings. Now, at the peak in 2000, which was the peak, I mean, that was the overextended valuation peak, 84% of the IPOs then had negative earnings. So what that says is that we're certainly at a very similar level of extremism as we were in 2000, and sentiment figures prove that point as well. And if this is going to be the ultimate top, which I think a lot of people, at least who study long-term cycles, think, then maybe you're going to get the ultimate stretch in this too. I mean, if somebody said, gee, would it be impossible to have a parabolic move in the stock market? And I would say, no, I don't think it's impossible. And maybe if it was going to happen, this would be the time to have it happen, or at least right before the end of this thing. I think you've got to be open to those things. The question is, do you want to play those with your safe money? That's all I'm trying to point out.
Well, point well taken. Garrett, we're out of time. Before we go, please, contact information for you.
My email is Garrett, Garrett, 111 at Comcast.net. And phone number is area code 925-820-0161.
Got it. Thanks, Garrett, for coming on the show. We'll talk to you soon.
Thank you, Michael.
You're welcome. Garrett Jones, money manager at StockMarketCycles.com. All right, we're going to come back with David Davidson. He's a chief trader at Shoreline Capital, one of the few remaining bear funds. I want to get his thoughts on what's going on the internals of the market. We'll be right back.
The Yorba Market Center utilizes the latest in web technology to bring you everything you need to manage your agribusiness more efficiently. We at Yorba Media invite you to be among the first to take advantage of your free trial of the new Yorba Market Center quote system, and that includes free mobile quote access. It's easy to use and cost-effective. So let us help you start your free trial today by calling us at 214-504-9470 or visiting us at yorbamedia.com.
Go to pagetrader.com right now and sign up for a free trial of Messenger Pro. Messenger Pro will give you the latest multi-day and multi-week price roadmaps for exactly where the S&P 500, gold, crude, the euro, and many other markets are going. Put the power of the roadmap to work in your next trade. That's pagetrader.com or call toll-free at 888-231-4702. pagetrader.com.
Tired of being on the wrong side of the trade? Frustrated with the Wall Street fat cats making billions? Smart money is now flocking to those who have a proven edge. InTheMoneyStocks.com has a proven track record of profitability, and they're willing to reveal their winning strategies. For over a decade, peers have reviewed the proprietary strategies created by the pro traders and investors at InTheMoneyStocks.com. It has been confirmed as the best trading and investing strategy in the world. Now is your chance to learn the expert methodology in this exclusive methodology Revealed webinar. You are well aware of the stock market collapse which occurred in 2007. The In the Money Stocks methodology located and alerted members of the impending collapse before it happened. Not only did members protect themselves during the collapse, they profited as well. Reserve your space for the next InTheMoneyStocks.com methodology revealed webinar by signing up under the education section at InTheMoneyStocks.com or email at support@InTheMoneyStocks.com. Your chance to obtain this powerful knowledge is now. Live the dream and profit for life.
Welcome back to the Traders Network. I'm Michael Yorba, your host. Thanks for joining us. We're broadcasting to you from Deep Ellum on Air. I've got David Davidson, is a chief trader at Shoreline Capital, one of the few remaining bear funds out there. I wanted to get his take on the internals. He's going to drill down into some of the markets for us. And just so everybody knows, it's SC-managementinc.com for his website. David, welcome back to the show. Thanks for being here.
Hey, Michael, how you doing?
Good, good. I got all the charts that you had sent to me, and also some of the comments that you had sent earlier on that. Can you walk us through your thought processes, and then we'll drill down into the different equities that you're picking out for today's show?
Sure. I think I've told you previously that my screening process is one where a lot of technical analysis involved. And I'm basically going through a list of a couple of thousand stocks on a daily basis. And what I'm looking for is stocks or groups of stocks showing high volume down characteristics. And last week, like last Tuesday, for instance, you saw a lot of the leading stocks in the marketplace get really hit on very large volume. And then to top that off, we got a big gap down on Thursday of last week on the Portugal Bank news. But then on Friday, then that same day on Thursday, the market then recovered most of that gap down, and we saw consolidation on Friday. And today we're seeing most of all that bad news of last week swept under the rug, and here we had a very strong Monday, so far. At the same time, today was a little bit interesting in that the Dow made a new high, and the S&P did not. And we had strong breadth at the beginning of the day, 5-to-1 up, when at the end of the day it closed about 1.85 up, and the volume was, again, light. So we're still in a period where it's not really, it's time to still be cautious on the short side. It's not time to be heavily short, but I think there's a lot of short sale setups in the marketplace.
Okay, let's talk about a couple of them. One of the first charts you sent me was Workday Inc. What's the significance of this equity that you're picking out?
Well, Workday Inc. is one of the leading cloud-based application stocks, and it was a monster leader. It had a big run. It went all the way up to almost $120. And then from the March-April time frame, it went all the way down to about $65. And now it's rallied back up on pretty low volume. And then last week, on that Tuesday through Thursday smashing, it got ripped pretty good, and now it sits right below its 200-day moving average line, which is at about $84. Now, the thing to point out here is I'm not saying this is a bad company. I'm not saying what they do is a bad business. But all I'm saying is that this is another one of those IPOs. This is another one of those cloud-based or social internet types of companies that doesn't make any money. They have no PE and they have no estimated PE. They don't make any money, and the stock trades. It's a big market cap stock. It trades a lot of liquid volume. So this is definitely an example of a potential short sale candidate. I think up at $84 in that neighborhood, which isn't very far away. If the market starts to get weak, this is definitely a short sale candidate.
Okay, all right. Is it too early for you to get some kind of a target? An idea where you think it will go?
Well, if you go back and to the exercise from the 2000 smashing, I think we've talked about it before. The best internet stock at that period of time, in 2000 was Cisco Systems. And Cisco Systems went from $80, and then at the lows, it went all the way to $8. And that was the best. That was the best company in that .com, boom bust. So where can this go? It can go a whole lot lower, and I mean a lot lower.
Okay.
Even Amazon, in that period of time in 2000, was another one of the leading internet stocks, and that stock went down 90%.
Get it. That's pretty significant. I get the significance there. All right, the next one that you'd sent to me was Yelp, Y-E-L-P.
Right.
All right, but break that out. Give us your, the rounded view of what you think's happening here.
Well, I think everybody knows what Yelp is. Yelp's a social networking company. It's a company where people can go and get reviews on all kinds of different entities, hotels, restaurants, you name it. And it's another one of these internet social networking companies that doesn't make any money. They have an estimated PE, which is NA, meaning not applicable. They're losing money. The stock had it's more or less, to me, it's a typical head and shoulders pattern, where you have a left shoulder building from September through December of last year. Then you had the head go up to $100, and then also through that internet smashing, it went from 100 down to 50, and now it's rallied back up to the $71 range. I think up at 75-ish. It's depending on how the market's acting. It's definitely a short sale candidate.
So you're getting a lot of internals. I'm getting the feeling from you that are have already turned, starting to get off of that relief rally, and then in Elliott wave terms, if you will, looks to me like they're finished with wave 2, and they're starting to approach a wave 3 process.
It's very much possible. The only thing we don't have going for us at the time is the indices aren't going down. These stocks will go down fast, and they'll go down a lot faster when the market all of a sudden turns and goes down with it. It's been my experience that's the way things work. When the markets, the indices themselves start to head down, these will head down faster.
Give our audience an idea of the amount of money that can be made using equities instead of indices, because a lot of these institutions are using the indices to hedge their positions, where they could make a lot more money by focusing on very weak equities.
Well, I think if you go back, we've talked about my performance during those bear markets of 2000,
right.
2002, and 2000 through the lows of 2009, and by using margin and of only 2-to-1 and no options, and focusing on these way overpriced equities, way over-owned equities that go down a lot faster, you make significant amount of more money than the indices themselves.
Well, let's quantify that in numbers, because you've got a track record. Tell our audience how far back your track record goes in doing what you do.
I've been a dedicated short seller since 2000. And from 2000 through 2013, I'm actually up 9% net. That's a total return from those 13 years. The S&P is up 25%, and the NDX 100 is down 3%. From 2000 through 2002, I was up 257%, and the S&P was down 50, and the NDX was down 70. And similar numbers for the 2007 through 2009 lows, except for I was up 170, and those indices were down about the same as the 2000 smashing.
Got it. I wanted to quantify that so people can get an idea of what can be done with somebody with your expertise if you're focusing on individual equities. Now, the next one I think you want to bring up with data. You seem to be focusing on the high-tech side of things, social network for now.
Well, these companies all fit into the same technical patterns and same fundamental patterns. Data is a analytics data visual software company.
Mm-hmm.
It had a big left shoulder build on it from August last year through January of this year. Then it had a big move up to $100, and then it took out the took out that left shoulder area, went all the way down to $55, and now it's gone. It rallied back up to 71, and now it's then of the smashing last week. You can see how illiquid these names are. It just got whacked all the way back down to 60. Today it trades up to 64, call it, and I think if it gets back up to 70, then it's definitely a short.
Okay. One of the techniques that you brought out last time you were on the show is that you have some very simple things that you look at: falling prices, higher volume. How is that for all the internals on the equities that we've already looked at and what you're about to show us? Are we getting that pattern?
You're getting that pattern on all of these names. When the stocks all went down from the highs, you had high volume breakdowns, and then we had then they rallied back up on low volume. And take this data, for instance, when it went down last week, it got whacked really hard on another big volume spike, and now it's rallying back up on very low volume. So it's very characteristic of short sale candidates, getting hit on high volume, rallying back up on low volume.
Even though the equities are rallying, like you said, and we may get a little divergence here because the S&P didn't make a new high and the Dow did, but even though the equities or the indices are rallying like they are you seeing more short candidates as we go forward or fewer?
I think I'm seeing pretty much a similar amount that I've been seeing for a while. I sent you some information because I do all these screens. And on the weekends, I put my list together of my 10 different sectors that I focus on, which would be telecom and media, technology stocks, financial stocks, consumer retail stocks, big cyclical stocks, oil stocks, transportation stocks, and REITs and home builders, and biotech stocks. And my list is pretty much the same, and that what to me shows is that if you look at the advanced decline line, you're seeing that the advanced decline line is not following the highs in these indices, meaning the rally is getting narrower and narrower, and the number of new highs is getting smaller each time we go higher. So there's a lot of names that are being set up as short sale candidates, and we have the earnings season coming upon us, and so we're going to have to see how these names and how the market responds to the earnings that are coming out.
Got it. All right, let's do this. David, let's take a break right now, but before we do, please give everybody your web address, your contact information so that they can contact you if they have further questions about what we spoke about on our show today.
Sure, it's www.sc-managementinc.com, and my phone number is 415-464-0991.
Now, is there a hyphen between SC and Management Inc.?
Oh, I'm sorry. Yes, there is. I'm sorry. There is.
Okay. All right. Let's make sure and make that determination. All right. Let's do this. Let's talk about the other markets that Coors and I think the symbol is P, right?
Yep.
On the other side of this break, and then we can wrap it up with what the general feeling is of what you see as how's the week going to play out. All right.
Sure.
All right, we'll be right back with David Davidson. He is the chief trader of Shoreline Capital, one of the few remaining bear funds out there. We'll be right back.
It's not your daddy's farm anymore. There's no doubt technology has changed the way we grow bigger crops, feed our livestock, and also access market information. With the new Yorba Market Center, today's farmers and ranchers are embracing new technology through smartphones, tablets, and the internet to give their business an edge. The Yorba Market Center gives you real-time quote access, news, and weather at a low monthly rate to help you stay better informed. Visit us today for a free trial at yorbamedia.com or call 214-504-9470.
Tired of being on the wrong side of the trade? Frustrated with the Wall Street fat cats making billions? Smart money is now flocking to those who have a proven edge. InTheMoneyStocks.com has a proven track record of profitability, and they're willing to reveal their winning strategies. For over a decade, peers have reviewed the proprietary strategies created by the pro traders and investors at InTheMoneyStocks.com. It has been confirmed as the best trading and investing strategy in the world. Now is your chance to learn the expert methodology in this exclusive methodology Methodology Revealed webinar. You are well aware of the stock market collapse which occurred in 2007. The In the Money Stocks methodology located and alerted members of the impending collapse before it happened. Not only did members protect themselves during the collapse, they profited as well. Reserve your space for the next InTheMoneyStocks.com Methodology Revealed webinar by signing up under the education section at InTheMoneyStocks.com or email at support@InTheMoneyStocks.com. Your chance to obtain this powerful knowledge is now. Live the dream and profit for life.
I'm Dr. James, founder of Diamond Physicians, a concierge medicine practice located in Dallas, Texas. Our Diamond 360 Advanced Physical Exam has been created for people like you who live a high-stress, fast-paced life. Every 40 seconds, someone in the U.S. experiences a life-changing heart attack or debilitating stroke. Negative stress tests and normal cholesterol levels do not exclude you. Half of all fatal heart attacks occur without warning. Diamond goes beyond traditional medicine with the Diamond 360 Advanced Physical Exam. Proven to prevent heart attacks, strokes, and diabetes. Contact Diamond now at 214-395-3491. That's 214-395-3491. Or visit our website at diamondphysicians.com to take the Diamond Challenge. If your Diamond 360 reveals perfect health, receive a full refund. Your loved ones will thank you.
Welcome back to the Traders Network. I'm Michael Yorba, your host. And we are broadcasting to you live from Deep Ellum on Air. All right, I've got David Davidson, Chief Trader at Shoreline Capital with us right now. All right, David, welcome back to the show. Thanks for being here. Appreciate it.
Thank you.
All right, when we left off, we're going through several equities. We've got a few more left on the table for you to bring out. I see just almost an exact pattern with everything that you brought to the table here. Pandora Media, excuse me. Give me your take on this one.
Well, you're very observant. Most of these names have very similar technical patterns. You could interchange the name or the symbol for most of these chart patterns. Pandora Media is another one of these companies. Everybody knows what Pandora does. Internet, music, and had a left shoulder building over on the left side from, like September through January, and then it rallied back up to 40. And then with the internet getting hit, it got hit all the way down to about 22. And then it rallied back up right to the 200-day at $29, $30. And then the smashing of last week took it down to 25, 24. And now it's rallying back up a little bit, but it's another one of these companies with doesn't have any PE now because it's losing money, and the estimated PE for next year is 162 times earnings. So I think up at $29, $30, it's definitely a short sell candidate.
All right. Is this the weakest sector that you see out here? Is that why you're bringing them up, or is it just happens to be the short du jour?
Well, I just think these are very, very good candidates of the big leading stocks in the marketplace that have been hit, and you can see what goes on with these leaders when things do turn and go the other direction. Because you asked me, how can you make this much money when the indices don't go down that much? And the answer is you look at these types of names that are completely overowned and overvalued, and they go down twice as fast.
Right. Okay. The next one that you got is Michael Kors Holdings, KORS.
Michael Kors, everybody knows, the big retailer, and it's been a very popular retailer, and it's had a very large run up to $100. And just today, the reason I bring it up today is because it had a big high volume breakdown below the 200-day line. It broke from 89 down to 85 and change, and it did it on 6.5 million shares, which is high volume. And the reason I bring it up is it's part of when I do my screening process, it's part of a very weak retail environment, telling me how weak the consumer is. When you look at stocks like TJX and Ross Stores and Lululemon and Coach and Ralph Lauren, stocks like that, this company, Michael Kors, trades at 27 multiple, and their peer group trades at around 19 times. So there's definitely room on the downside for this for multiple contraction.
All right, just so the viewing audience can get an idea on this, is this absolutely one of your classics where you've got much higher volume, falling prices? Is that what the viewing audience should be looking at in order to take a look at the portfolio, the equities that are in their portfolio, and saying, wait a minute, I could start to be in trouble if this continues?
Exactly. They should look at their stocks on a daily basis and see what the action is in terms of the price and volume action. And if they start to see their holdings breaking down on large volume, it's time to consider taking some chips off the table, yes.
Is there a gauge that you're using, a threshold, to determine, okay, now the volume is, you've got an average volume, and then you've got outside of that window. Is there a percentage gauge that you use that's a threshold that says, all right, anything over this percent off the average volume is my warning signal?
Well, no, what you're really looking for is how's the volume today versus, well, yeah, I do, I'm sorry, it's the 50-day moving average volume on the stock. The 50-day moving average on this stock is 2.8, and today you had a 3.8 million share move.
That's what I was driving at. Okay, so as a rule of thumb, you start getting past that threshold.
You look at the 50-day moving average volume, yes.
Correct. All right, that's what I wanted to find out. Okay, let me back up. Now, those are great candidates, and you've given us all the thresholds, and really I want to applaud you, because more so than just giving us the thresholds, you've given us the potential setups for this ensuing rally. If it gets up to XYZ, as we've done through all these equities, that's when you're going to start pulling the trigger, provided everything else sets up, I'm sure, on the initiation of shorting the market. But at this point, you're saying don't get too excited just yet. Wait for these setups to hit. Am I getting that right?
Well, you are, and today was an example. I mean, we had a higher gap opening here, and it took the main indices up until late in the morning. Like I said earlier, we had a very positive breadth going on at 5-to-1 positive, and then the stock market, gave back some of their gains. Didn't give them back very much, but the advanced decline line deteriorated, significantly. Went from 5-to-1 positive to 1.85 positive. And the volume was very light, and I think everybody's going to wait to see tomorrow, because Janet Yellen is going to speak tomorrow and Wednesday, and we're going to see what the market thinks of what she has to say.
There are other indices that you look at, other markets that you look at. Spend a few minutes with us on what the surrounding markets are telling you.
Well, if you want to look at, markets that are closely correlated to our market, if you look at the Russell 2000 index, the Russell 2000 is definitely the weakest index in our marketplace. It peaked in March at 1,200, a little over 1,200, went back down to about 1,100, came back up to 1,200, and now it's back down. So it tried to break out, and it didn't break out. Right now, it's on a failed breakout. And the same goes for the UK market over in England. That stock market was trying to make a new high, and then it broke below its 200-day. And today it rallied up with our market. The same thing's going on with the German market, and the same thing's going on with the French market. These markets are definitely a lot weaker than the U.S. market. And so that, to me, is another divergence that has to be, focused on.
Are you thinking that we're going to start to see some of these support levels broken in Asia and Europe here before ours does? Is that going to be our little tell on this?
Well, the French market already broke below its 200-day. The UK index, one second, I believe, it already broke below its 200-day, but it's rallied back up off it. And the German index has already... It hasn't. It broke the 50-day, and now it's trying to rally back underneath the 50-day moving average. So our markets are still above the 50 and the 200-day, except for the Russell's acting a lot weaker.
Do you think it's just a function of there are weaker markets, or there's money coming out of those markets and trying to find a safe haven here in ours, and that's what's propping ours up?
Well, the thing that's interesting to me about those markets, and maybe we should have talked about a couple of them, but the foreign bank stocks look really bad.
Right.
And I'm talking about Barclays Bank. I'm talking about UBS. I'm talking about Deutsche Bank and Credit Suisse. Those stocks look really bad. So that to me is some type of indication that things aren't so great over in the European Union.
Do you see more sovereign debt to defaults coming to the surface in the near future?
Well, you had the Portuguese bank situation. Everybody came out and everybody could see that everybody over there owns all the same instruments. So do I think that more is coming? Absolutely.
All right, and is that really similar to 2008? They had the credit default swaps really taking the brunt of what was going on with the all of the the bad mortgages that were made by the mortgage industry. Do you see that's going to really be our crack in the dike on this one?
Well, I think it's going to be part of it. The credit bubble that's been blown up this time around is it's just this huge experiment. And, the European central banks are all in on the same game that the QE people over here are using. And it's just not a sustainable situation. And one of these days, Michael,
I'm looking at the bond market right now. I'm talking about the futures bond market.
Yeah.
It's made a turn today. It's below Friday's low. And there's been some analysts on the show that's saying this right now, this month, is when we're going to see a turn in interest rates, and that obviously we're waiting for Yellen to talk to us tomorrow. But take on that before we close out the segment. I think we got about a minute or so left.
Well, the only thing I can say about it is earlier in May, I'm looking at the 10-year bond. Was trading at 126, and then went down to 124. I'd say right now it's in no man's land. I don't see anything that's making me want to get really negative on the bond market, even though I think that one of these days it's going to get cracked because it's such a huge bubble.
Got it. All right. Well, actually, I do have one more minute left. The dollar. Everybody is watching our currencies or our currency. I wanted to get an idea what you thought about that is before we close out.
Well, the dollar, it continues to hang around this 80 level. It's been going sideways between 79 and 81 for almost a year, and I think that you tell me why the euro trades at a higher rate than the dollar. I really don't know. I think those European Union banks are in a lot worse shape than ours, even though I think they're all in the same boat. But I could see the dollar maybe rallying, to be honest with you.
Okay, I got that. All right, let's close the show for today. But David, I want to appreciate you being back here. You're going to be on with our show. Give us the start off for the week every week. One last time, if you would, contact information for you.
www.sc-managementinc.com 415-464-0991.
Great. David, thanks for showing up today, and we're going to be watching those stocks as we go throughout the week.
Thanks, Michael.
My pleasure. All right, everybody, I want to thank you all for tuning in to our show today. We're going to continue to bring you content you just can't get anywhere else. And also to let you know, we're going to go back into the Clear Channel Studios 6:30 to 7:30 drive time and start cranking up our CEO interviews from NASDAQ and big board big board companies. That starts today. I ran a little rerun, but tomorrow we'll be live Tuesday, Wednesday, Thursday with that show. And if there's anybody out there that you think needs to be on the show, any content that you think we need to bring out so people can stay on the right side of the market, please let us know. YorbaMedia.com. And go ahead and go there. Join up with our social network so that you can get access to the people we bring you to keep you on the right side of the market. Thanks for tuning in. We'll talk to you again tomorrow.
Thanks for listening to today's program. The Traders Network is a production of Yorba.tv LLC and is streamed live and archived at YorbaMedia.com. We invite you to listen live, join in the conversation real time, and link to the Traders Network on the Yorba Media website. All opinions in this show are that of the presenters or their guests, and not of this station's owners or management. These opinions are for educational purposes only and should not be interpreted as investment or financial advice. All investments involve risk, and past performance is not indicative of future results. Tune into the Traders Network every Monday through Friday afternoon from 2 to 3 p.m. here on 1190 a.m.